Now we will learn some special issues that we need to remember when we will solve complicated lease problems. One of the issue that is frequently discussed is residual values. So residual value is the value that we get at the end of the lease term from that asset. And residual value could be guaranteed or it could be an unguaranteed part, which means the expected value which equals to guaranteed plus unguaranteed part. Now we will see both parties' perspective where and when we will include this type of residual value when we will calculate the lease liabilities or when we will do the lease receivables part. So here, let's see from lease's perspective, and residual value could be guaranteed and unguaranteed. So here we will see some guidelines. And let's see, first guideline is related to guaranteed residual value. So if the residual value is guaranteed, then we have to look for some other information. We have to also check about the expected residual value. So if the expected residual value is equal or greater than the guaranteed residual value, then the lessee will not include this guaranteed part to lease liabilities. If you remember the finance lease example you learned earlier, and there was a guaranteed residual value, but the expected residual value was greater than the guaranteed residual value, and that's why we did not include it when we calculated lease liabilities. On the other hand, if the expected residual value is less than the guaranteed residual value, what we will do? We will take the difference between the expected and guaranteed residual value, and we will take the present value and we will include it in the lease liabilities. Remember, we are talking about these lease liabilities. But when you have to do the present value test from lease's perspective, we will include the guaranteed residual value for the present value test. But lessee always ignores the unguaranteed residual value. Now we will see here how about the unguaranteed residual value. So first of all, to do the lease classification test, the lessee does not include unguaranteed residual value. And to calculate lease liabilities, the lessee does not include any unguaranteed residual value in the lease liability calculation, because usually at the end of the lease, the lessee returns the assets to the lessor without any other payment. So we have seen this in our previous illustrations. Now let's see the residual value accounting from a lessor's perspective. So for our lessor's perspective, we will see both type of residual values, guaranteed and the unguaranteed part. And for the guaranteed residual value, the lessor actually take the present value of the guaranteed residual value and they subtract it from the fair value of the asset when they calculate the amount that needs to be recovered by the lessor. That amount you can also call that annual rental payment or installment. So lessor actually exclude the present value of the guaranteed residual value when they calculate the installment or the payment and by which they will recover the amount. So now, how about unguaranteed residual value? So for unguaranteed residual value, lessor actually included for lease classification test. But if you remember, lessee never include any unguaranteed residual value, neither for lease classification test nor for measuring the lease liabilities. Now here, how about the measurement of lease receivables and how about when they record the sales of that assets for finance lease? So the lessor recognizes sales revenues and cost of goods sold only for the portion of the asset for which the recovery is assured, and both sales revenue and cost of goods sold are reduced by the present value of the unguaranteed residual value. So that means they will also include here the unguaranteed residual value. So this table actually will summarize everything for you. So first you will see Leases perspective, classification test. We include the guaranteed residual value to know the present value, and then we compare it with the fair value of the asset at the beginning. But unguaranteed, Lease will ignore for classification test. On the other hand, for measuring liabilities, if the expected value of the residual value is greater or equal to the guaranteed, then the lease will ignore it. If the expected value of residual value is less than the guaranteed residual value, then we will take the difference and we will take the present value of the difference and will consider those in computation of lease liabilities. And unguaranteed residual value we don't include. The leasee does not include it. From lessor's perspective classification test, the lessor include the guaranteed residual value but does not include the unguaranteed. For measuring the lease receivables, the lessor include both the guaranteed residual value and unguaranteed residual value. Now we will learn about some executory costs. So executory costs are some type of cost that actually related to owing an asset. For example, if you lease a building, so the building might have insurance and property tax, so or few others executory costs. Now whether we will include it or not when a lessee will calculate the lease liabilities. Remember, if the lessor considered those executory costs when they determine the lease payments, the lessee will also include those in the lease liabilities. But there are some executory costs, especially tax payment or insurance payment, that are made directly to the third party. Those type of payments are not included in the lease liabilities. Rather, those are shown as expenses. Now we will see some other information about lease prepayments and incentives. Sometimes lessee can make some payments even before the lease contract is signed or prior to the lease commencement date. Or we will also see that those type of lease prepayments made by the lessee that will increase the right of use assets. Sometimes you will see that the lessor may make some lease incentive payments to the lessee so that the lease can be executed, but those we will reduce or subtract from the right of use of assets. And then there are some indirect costs, and those will be incurred by the lease you will see here. So that will be added when we will calculate the right of use of assets. So this little chart or picture will help you to remember initial measurement of lease liabilities and lease prepayments, and then we add lease prepayments to that, and if any payment made by the lessor as lease incentives, we subtract that, and initial direct costs we include that. This is how we measure the right of use assets. Now we will see some examples of initial direct costs. Remember, these type of costs are usually paid by the lessor, and whether we will include or exclude those, especially when the lessor will actually record the cost of the right of use assets. But remember, these type of initial direct costs are not recorded as part of the lease liability. So these are incremental costs, those would not have been incurred if there is no lease contract. For example, you will see here some items, those we can consider initial direct costs, but what are the initial direct costs the lessor will consider? Commissions or legal fees for lease execution, lease document preparation cost, or consideration paid for a to a third party who can guarantee the residual value. So those are the items, those will be included in the cost of the right of use assets. But remember, these initial direct costs, we don't include it as part of the lease liabilities. On the other hand, some other initial direct costs, for example, employee salaries, and here you will see some other advertising depreciations, those might have been occurred even though there is no lease here, so the lessor will exclude those. So you will see again a summary here. The lessor will deal with this initial direct cost, and it depends what type of cost are those and what type of lease are those. So for operating leases, a lessor defers the initial direct cost and amortizes them as expenses over the term of the lease. On the other hand, sales type, which you also know finance lease from a lease's perspective, the lessor expenses initial direct cost at lease commencement, but if there is no selling profit or loss, the initial direct cost can be deferred and recognized over the lease term, just like the operating expenses. And there are some other costs, mostly those are initial or direct costs, but internal cost, we also saw the example in previous slides, such as advertising or servicing, or maybe they might need some expenses for credit reports. So those we actually do not include. Now we will say a little about the bargain purchase option, and you have seen this concept here when you did the lease classification test. So this bargain purchase option means that the lease term includes a condition that the lessee has an option to purchase the asset at way lower price compared to the fair value of the asset that time. So it's way lower. It's so lower that it's very certain and reasonable that the lessee will exercise these options, because for present value test we need to calculate the present value of the lease payment. So we need to include this type of bargain purchase option in lease payments, because these type of bargain purchase options are so certain that the lessee will definitely exercise it. So we will also take the present value of that bargain purchase option amount, and we will this will also include in the lease payments. You will also see some other examples. These are very common in real world. For example, short-term leases. These lease terms are usually 12 months or less. For example, you are leasing an apartment, and in this type of cases, usually lessee selects or elects these to record as an expense, and renewal or termination options are very reasonable and certain. So these are few issues that you need to know when we'll solve some complicated lease problems. And this is a summary of the financial statement presentation. You already have seen examples, but these 2 slides will help you to remember it. Remember, no matter it's a finance lease or operating lease, from lease's perspective, lessee must need to show it on their balance sheet. On the asset side, they will call it right of use asset, and on the liability side as lease liabilities. Now, how a lease will impact on lease's income statement. You remember the lease payment for finance lease, we split it interest expense, and the remainder of the rental payment or installment we show it as amortization expense. On the other hand, the fixed installment or lease payment in case of an operating lease, the lessee just show it as a lease expense. This is how lease's financial statement will be impacted because of a lease. No matter it's the finance lease or operating lease, you see the balance sheet impact is now the same. Now, how about leaser's perspective? So leaser's perspective, of course, for sales type lease, leaser will record the lease receivables on their balance sheet, and then these lease receivables are presented separately from the other assets so that we know this is the asset, is still on the balance sheet, but it's already leased. And then on the other hand, for sales type lease, the leaser will also record interest revenue, and they also record the sales, that asset, and cost of goods sold. On the other hand, for operating lease, the lessor actually continue to show the asset just like a regular asset, plant, property, equipment. And the lessor will also record the revenues, and these revenue, they at the beginning, they show at beginning of the year. If the lease installments are made at the beginning as an annuity due, they will show it as unearned revenue, and later they will recognize the earned revenues. And since the asset is still shown as a regular asset, then the lessor will also do the depreciation expense. Now we will see not only the numbers and the items will impact on your income statement and balance sheet, there are some other additional information. Those are qualitative information both parties, lessee and lessor, would put on their financial statement in footnotes. For example, the nature of the lease, and if there is any variable payments, how those are determined, and any other conditions, for example, residual value related information, or information how they calculated the discount rates. All these both needs to be disclosed by both parties. So this last part of the lecture, you just learned some concept, and we'll see some applications when we'll practice some exercise problems. But these concepts are really very important for your conceptual knowledge check on leases.